Hey everyone, and welcome to This Explainer. Today we're unpacking something pretty huge, the crucial provisions of Chapter 12 of the new Income Tax Act 2025. Whether you're a chartered accountant, a tax professional, a CA student, or running a business, getting a grip on the approved modes of payment under this new statutory framework is absolutely essential. The laws around cash transactions have tightened up significantly, and compliance is way more digital than ever before. So let's jump right in and get you fully up to speed.
So, picture this. You're facing a common business scenario. You need a quick cash injection for working capital, and a relative generously offers you a 5 lakh rupee loan in cold, hard cash. You take it, right? Well, under the new Income Tax Act 2025, doing that could literally cost you exactly 5 lakh rupees in penalties. Crazy, right? Let's figure out exactly why that is. Here is our roadmap for today. We'll start with an introduction to payment modes, then key legal provisions explained, followed by real-life taxation examples, compliance and practical issues, and finally, key takeaways and summary.
Section 1, Introduction to Payment Modes.
Okay, so for all you seasoned CAs and tax pros out there, let's build a bridge from what you already know to the new 2025 Act. You've spent years advising clients based on the old 1961 Act, right? Well, the new Act just reorganizes things to fit our modern digital economy. Think of this as your new mental map. The old Section 269 SS for taking cash loans, that is now Section 185. Section 269 ST, which capped large cash receipts, becomes Section 186. The electronic mandates for large businesses under 269 SU have moved to Section 187. And finally, repayment rules from 269T sit perfectly in Section 188. The section numbers changed, but the ultimate goal remains exactly the same, crushing the parallel cash economy.
Oh, and a quick heads up on a fundamental terminology shift. You know how we always used to juggle previous year and assessment year? Yeah, scratch that. As clarified in the transitional FAQs, we now use one simple, unified term, the tax year. So if we talk about turnover limits in the preceding year, we are strictly referring to the preceding tax year. It just makes compliance tracking so much cleaner.
Section 2, Key Legal Provisions Explained.
All right, let's get into the actual black letter law. What makes a transaction valid under this new regime? Sections 185 and 186 are your gatekeepers here. Section 185 strictly governs taking loans or deposits, and 186 caps those large cash receipts. The golden rule, you have to leave a verifiable banking footprint. We're talking account pay checks, account payee bank drafts, or electronic clearing systems. Cash is out, and importantly, the law also permits what it calls other prescribed electronic modes.
So, what exactly falls under other prescribed electronic modes? Well, for that, we turn to Rule 48 of the newly drafted Income Tax Rules 2026. This is the stuff we all use every day. It explicitly approves credit and debit cards, net banking, IMPS, UPI, RTGS, NEFT, and BIM Aadhaar Pay. So taking that high-value loan via UPI or NEFT, you're completely compliant with Sections 185 and 186. No sweat.
But here is where things level up a bit. 50 crore rupees. If your business or profession crossed 50 crore rupees in total sales, turnover, or gross receipts in the immediately preceding tax year, well, Section 187 imposes an extra mandatory compliance layer. It's no longer just about how you take loans, it's about the payment infrastructure you actively offer to your customers.
For the big players crossing that 50 crore mark, Section 187 activates Rule 133. And Rule 133 is mandatory. You absolutely must provide facilities for your customers to pay using RuPay debit cards, Beam UPI, UPI QR codes, and specific Tier 3 central bank digital currency or CBDC wallets. Basically, just having a standard swipe machine for international cards doesn't cut it anymore. You have to actively support these indigenous digital payment infrastructures.
Section 3, Real-Life Taxation Examples.
Let's see how this plays out in the real world, because making a mistake here is pretty brutal. Imagine a retail business. They had a 60 crore turnover last tax year. Step 1, they hit a liquidity crunch and take a 5 lakh rupee loan from a supplier in cold, hard cash. Step 2, an audit reveals they only accept Visa and MasterCard, no BIM UPI, no RuPay anywhere in the store. Step 3, the assessing officer flags this immediately. This business just broke Section 185 by taking the cash loan and Section 187 by ignoring the mandatory digital infrastructure rules for high turnover businesses.
The fallout from this is massive. Under Section 451, the assessing officer is empowered to slap them with a penalty equal to the exact cash amount received. So that 5 lakh cash loan, bam, a 5 lakh rupee penalty. A literal 100% fine. And it gets worse. Section 452 hits them with a recurring daily penalty of 5,000 rupees for every single day they fail to offer BM UPI and RuPay. As you can see, ignorance of Chapter X can totally wreck a business financially.
Section 4, Compliance and Practical Issues.
For our CAs and accountants out there, it's your job to build a fortress around your clients so they don't get hit by these automated penalty provisions. Here is your game plan. First, meticulous documentation is non-negotiable. Ensure absolutely every high-value loan or deposit routes through those Rule 48 approved digital modes. No exceptions. Next, flawlessly match reported expenses with core accounting records. Third, you've got to verify the PAN and TDS details of service providers before initiating any major transactions. And finally, keep your audit trails spotless. Retain every single supporting bank statement and digital receipt.
Now let's talk about where people actually mess this up in the field. A massive pitfall is confusing the general modes in Rule 48 with the mandatory modes in 133. Business owners often think, hey, we have net banking, we're good for Section 187. Nope. If you're over that 50 crore mark, Rule 133 demands BGM UPI and RuPay. Another classic mistake is still using previous year in internal audits, causing filing mismatches. And please don't ignore system downtimes. If your UPI QR scanner is broken for a couple of weeks, that 5,000 rupee daily penalty under Section 452 is silently accumulating in the background.
Section 5, Key Takeaways and Summary.
Let's wrap this up with 5 key takeaways you can apply right now. Number 1. Sections 185 to 188 of the ITA 2025 are your new rulebook, effectively replacing the old 269 series. Number 2. High-value cash loans are a massive red flag. Stick to Rule 48 digital modes. Number 3. If you cleared 50 crore in turnover, you absolutely must offer Rule 133 facilities like BM UPI and RuPay. Number 4. Failing to comply is super expensive. You're looking at a 100% penalty on the cash under Section 451 and a 5,000 rupee daily fine under Section 452. And finally, number 5. Update your vocabulary. It is all about the unified tax year now.
Mastering Chapter 12 isn't just about ticking compliance boxes. It's about bulletproofing a business in a digital-first economy. So ask yourself, is your practice genuinely prepared to defend against tomorrow's automated digital audits? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.